Welcome back to Wealth Mind Investing. Today we're analyzing a dramatic market event that has everyone's attention. The silver market has experienced a substantial decline, dropping over 20% from recent peaks, with nearly 17% of that occurring within just one day. Current trading shows silver at approximately $95 per ounce. Gold has also retreated, now positioned under the $5,000 mark. Before we dive deeper, if you find this analysis valuable, please hit that like button and subscribe to Wealth Mind Investing for more unbiased market insights. Your support helps us bring you quality content regularly. Now, let's examine what's happening in the markets and why this movement is so significant. Technical analysis unfolding. In our recent analysis, we identified specific technical indicators to monitor. The 150-hour exponential moving average was highlighted as a crucial level. Initially, this level provided support, resulting in approximately 10% price recovery. However, subsequent selling pressure pushed through this threshold, leading prices toward the $90 to $95 zone we had previously identified as the next major support area. This is precisely where we find ourselves now, testing whether this support zone can hold, or if we'll see further decline toward the $86 level. Paper versus physical market divergence. Here's where the situation becomes particularly interesting. While exchanges in New York show silver trading around $95, the Shanghai market tells a completely different story. Physical silver there is trading near $136 per ounce. This creates a premium of approximately $36, representing nearly 37% above the paper price. This is historically unprecedented. Physical metal in Asian markets is commanding significantly higher prices than futures contracts in Western markets. Think about what this means. We're witnessing volatility levels typically associated with cryptocurrency markets, not traditional safe haven assets. Over $1 trillion in silver market capitalization has been eliminated in a single 24-hour period. This appears to be forced liquidation, paper markets experiencing extreme pressure while physical markets signal entirely different fundamentals. Examining the fundamentals. Let's look at some revealing ratios. Currently, gold trades at approximately 51 times the price of silver. However, the mining ratio tells a different story. For every single ounce of gold extracted, roughly 8 ounces of silver are produced. Storage ratios in major vaults show even more silver relative to gold. Yet the price relationship doesn't reflect this supply reality. Additionally, physical inventories at major storage facilities are declining while price ratios continue expanding. This disconnect raises important questions about true market dynamics. Timing and catalysts. The timing of this decline deserves attention. Reports indicate the sell-off began during Asian trading hours. Interestingly, the London Metal Exchange announced operational issues causing delayed opening. This coincided with significant price drops. Beyond technical factors, markets are focused on potential policy announcements, particularly regarding Federal Reserve leadership. Speculation exists around whether conventional appointees or those favoring monetary policy reform might be selected. Some economists advocate for gold-backed monetary systems as a mechanism to control inflation and limit unchecked monetary expansion. Such advocates propose gradual transitions through instruments like gold-denominated bonds. These ideas challenge current fiat monetary frameworks. If policy shifts toward sound money principles occurred, it could fundamentally alter precious metals markets. The paper derivative system could face significant structural changes. This is why timing matters. This is why today's potential announcements carry weight. This is why some believe this price action occurring before major policy decisions isn't coincidental. The unprecedented physical premium. That $36 Shanghai premium is historically significant. In previous market corrections, physical premiums typically compressed as sellers panicked. This time is different. Premiums are expanding. Asian buyers are aggressively purchasing at 37% above spot prices. They're not deterred by paper market volatility. They're viewing this as opportunity. This suggests they recognize the paper price as disconnected from physical reality. Every dollar of paper price decline appears to increase physical demand. Every short position in futures markets gets absorbed by physical delivery requests. Market makers may be inadvertently tightening physical supply while attempting to manage paper positions. Technical outlook and risk assessment. After a 20% plus decline, we need realistic risk assessment. The technical damage is real. Short-term momentum has turned negative. We're testing the $90 to $95 support zone identified in our previous analysis. If this level holds, recovery potential exists. If it breaks, the next technical target sits around $86 or potentially lower. Traders using leverage have likely faced margin calls and forced liquidation. This volatility environment is extremely challenging for leveraged positions. Additionally, if conventional policy paths continue without reform towards sound money principles, paper market manipulation could persist. Further technical breakdowns remain possible before finding sustainable lows. Bitcoin has also declined significantly, approaching $81,200. Broad market weakness is evident across multiple asset classes. If this represents broader risk-off sentiment with tightening liquidity, precious metals could experience near-term pressure despite their safe haven characteristics. Structural fundamentals remain intact. However, short-term trading risks don't alter structural physical market realities. That historic $36 Shanghai premium doesn't indicate weak demand, it indicates desperate demand. Physical buyers willingly paying 37% premiums are positioning ahead of potential supply constraints. The gold-silver price ratio at 51:1 versus mining ratios around 8:1 suggests significant silver undervaluation relative to gold. Historically, when this ratio reaches such extremes, violent corrections occur, typically with silver outperforming substantially. Physical inventories at major exchanges continue declining. Asian markets continue pulling metal eastward at substantial premiums. Physical market tightening continues while paper markets crash. This divergence cannot persist indefinitely. Either paper prices must rise toward physical prices, or paper pricing mechanisms lose credibility with physical markets becoming true price discovery mechanisms. Validation of analysis. Our technical framework from recent videos is proving accurate. The 150-hour EMA provided initial support with that approximate 10% bounce, then broke as predicted. Price declined to the early $90s as outlined. Now we're testing that $90 to $95 support zone. The technical roadmap continues unfolding as analyzed. Physical fundamentals signal shortage, while paper signals liquidation. 3 key takeaways. First, our technical analysis is playing out with precision. The 150-hour EMA held initially, then broke. Prices declined to early $90s as predicted. We're now testing $90 to $95 support. If this holds, recovery potential exists. If it breaks, $86 becomes the next target. Second, the physical paper disconnect has reached unprecedented levels. The $36 Shanghai premium, 51:1 gold-silver ratio against 8:1 mining ratios, and draining vaults while prices crash. This represents paper manipulation meeting unstoppable physical demand. Third, potential policy changes could be catalyst for major shifts. Appointments favoring sound money principles versus conventional approaches could determine whether paper manipulation continues or faces systemic challenges. The critical question: will $90 to $95 support hold or break? If it holds and we rebound, could policy changes accelerate upward movement? Or will we see further technical damage toward $86 before physical reality overwhelms paper fiction? We're at a critical inflection point. Technical levels we identified are being tested now. The physical market shows maximum divergence from paper pricing. Potential policy changes could validate sound money principles. Stay vigilant. Monitor these levels closely. Watch for policy announcements. The next moves could be historically significant. Final thoughts. Conduct your own research. Understand the risks fully. If you're using leverage, this volatility environment is extremely dangerous. If you're building physical positions and understand structural fundamentals, this could represent the shakeout before significant moves. Time will reveal the outcome. Invest with logic and analysis, not emotion or hype. If you found this analysis helpful, please like this video and subscribe to WealthMind Investing. Hit that notification bell so you don't miss our future market updates. Drop a comment below with your thoughts on where silver heads next week. Thank you for watching WealthMind Investing, where we empower your financial decisions with unbiased market analysis. Until next time, invest wisely.